It's Tuesday, January 15th. Welcome to Market Foolery. I'm Chris Hill. Joining me in studio today, it's the Chief Investment Officer of MFAM Funds, Bryan Hinmon. Good to see you.
Chris, it is wonderful to be here in Virginia.
So I didn't even know you were going to be in town because you're out in our Denver office, and it was a happy surprise to bump into you. Yes.
I don't tell many people because my calendar is already slammed, so I stuck you in here.
I appreciate that. The dozens of listeners appreciate that. We're going to get to Netflix in a second. I think we should start with JPMorgan Chase because this appears to be a story that is bigger than just one Wall Street bank's earnings report. The headline is that for the first time in nearly 4 years, JPMorgan Chase came in below expectations. I don't know to what extent you follow that bank or any big Wall Street bank closely, but the CEO, Jamie Dimon, his comments to me are the real story. But first, let's just stick with the bank. How interesting are the big banks, whether it's JPMorgan Chase or others, to you?
They're not overly interesting. However, JP Morgan is, I'd say, one of probably the 4 top conference calls that I personally listen to on a regular basis to get my bearings for what's going on in the economy and in the markets. So I tend to listen to JP Morgan. I tend to listen to Paychex, Fastenal for the industrial side, and then Mastercard or Visa. And if you listen to those 4, you get a pretty good lay of the land of what's going on domestically, but also globally in a lot of cases. JP Morgan's worth listening to because they are the largest bank in the U.S. They're the largest credit card issuer. They're the second largest merchant acquirer, and they're the largest investment bank. So this is a behemoth that has their fingers in a lot of what makes the economy and the market go. And their year was very good. The quarter was a little noisy, and what's going to get the headlines in the quarter here was they had a big miss in their trading department. And that is naturally a noisy part of their business. And so I'm going to let the traditional news sources take care of that one and just put that to the side because it's not really indicative of, I think, what's important or what's going on truly in driving their business. The place that I like to look is what they're saying about the U.S. economy and about consumers. And as you noted, it's important to read the comments and understand what Jamie Dimon and his company is saying. And I'll read you a couple of quote excerpts here real quick. Healthy and engaged U.S. consumer that is spending, saving, and investing. And he also said that credit is pristine. And then the CFO said the outlook for growth in the economy is still strong and that internationally, slower but still positive global growth. So those are good things to hear.
They are good things to hear. One thing, you mentioned the miss in the trading department. And I get that in the grand scheme of things, Jamie Dimon doesn't particularly care about one miss in one quarter, and he said as much on the call. Basically, I don't really care about that. My hunch, though, is that if you work for Jamie Dimon in the trading department, that's not how it's behind closed doors. That's not how the conversation is going. That's for them to deal with. I'm just saying, I saw that quote and I thought, I don't know about that. I bet if you work for him, you're hearing a different tune.
So they definitely run a tight shop at JP Morgan. I mean, this is the bluest of blue chip banks that there are. They escaped relatively unscathed through the financial crisis, and they were one of the few rare banks to have that. And Jamie Dimon and the way he runs things and his team deserve a lot of credit there. I think he's much more willing to tolerate revenue misses. He is much less willing to tolerate rampant risk taking. And you see this in how the company presents its data and talks to investor. They always quote their fortress financial position and their fortress balance sheet. So they very much understand that or put risk management first and foremost, and are much more tolerant of misses on the top line.
So Dimon's comments about the state of the U.S. economy, and in particular the government shutdown, which is now the longest government shutdown in our country's history, you couple that with the fact that this morning the White House came out saying that they're now doubling the estimate of the cost that the government shutdown will, the impact on the economy. You take those two things together, and Dimon saying, yeah, this is going to be problematic for a number of reasons, not the least of which is delaying IPOs. And we had talked on Motley Fool Money a couple of weeks ago about how towards the end of 2018, despite the volatility, there were reports coming out that IPOs were actually going to be sped up in the first half of 2019. Clearly, if the government shut down, that's not going to be the case. So all of this together is a little concerning, because I think, as you said, Dimon runs a great shop. He's incredibly smart. He is highly respected. And if Warren Buffett is the economic reassurer in chief in our country, Jamie Dimon is probably on the short list to come right after him. So it is one of those situations where when Dimon talks about the economy, he does so in very smart and measured ways. And this is a little troubling.
Agreed with all of that, Chris. And I think it's worth noting that I think Buffett recently purchased more JPMorgan shares. So he sees that as well. The government shutdown and its impact on IPOs, I think, is more concerning to you and I than it should be to most. 2019 is going to be a big year for splashy, important IPOs. I mean, companies out there like Airbnb, Uber and Lyft, Slack, yeah, just to name a few, are the big headliners. They are going to go public not because they're desperately in need of money and are going to be in some cash crunch if they're pushed out a quarter. So I don't see that as being, among the big impacts that the government shutdown could have. Again, I think where it comes full circle is, we have so many workers here in the DC area that have been furloughed, and their day-to-day lives are impacted by not getting paid. And that reverberates throughout, or can reverberate throughout the economy. And so that is why my focus is squarely on Dimon's comments around the U.S. consumer and even U.S. businesses and the impacts that it might be having there. And he was fairly reassuring, I think, on this call, which together with his comments about the credit being pristine and their loan books still growing, I'm not worried yet. However, the longer this does go on, the longer it begins to shake consumer confidence, even outside of those directly impacted. And we'll start to see that playing out in bad ways.
Not that I'm overly concerned for what your work life is like. I'm a little concerned, but I can't say it's a day-to-day concern. But I am curious if the economic uncertainty in the United States makes it harder for you to do your job when you are looking at different companies and you have almost this ripple effect of, we have the government shutdown, we have economic uncertainty, and therefore CEOs across any number of industries are giving, if not less guidance, they're giving more vague guidance because it's harder for them to plan.
It actually makes our job easier in some ways.
Kudos.
Yeah, well, because it creates uncertainty, it creates volatility, and that creates more opportunities for us. We spend our time trying to understand the guts of businesses and make our own assessments on what their futures are going to be. And if companies issue less guidance or less helpful guidance, we tend to find larger spreads between what we think is reality and what the market is pricing in as reality. And so it creates more opportunity for us. It creates more chaos in our day-to-day, of course, as investors are clamoring and worried and asking for their money back and that sort of thing. But from the pure investing side, it actually makes the job more interesting and easier in some ways.
Let's move on to Netflix. Netflix shares are up 6% this morning after the company announced it is raising prices depending on the plan. Prices are going up anywhere between 13% and 18%. per plan. This is taking effect immediately for new customers. Existing customers are going to be grandfathered in over the next few months. And not at all surprised that shares of Netflix are up. I mean, we love to see companies with pricing power. This has demonstrated in the past that it is a company with pricing power, and they're flexing their muscle right now. Good for them.
Yeah, I think there are two sides to this story. The first is they can do this because the gap between what consumers pay for a subscription to Netflix and consumers pay for alternatives is wide, especially given the value proposition. So the average Netflix bill is about $100 a year. The average Comcast bill is about $1,000. The average DirecTV bill is about $1,400 a year. Now, of course, that Netflix subscription cost doesn't include internet, but most people are going to have that anyway. So there is a huge gap between what you're paying for Netflix and what you're paying for sort of the next man up, the alternative. And then, frankly, I think that consumers believe that Netflix is raising prices, not just so they can pad their bottom line, but so they can invest in the consumer experience, invest in more content, and make that value proposition even stronger. So I think Netflix has earned the right to raise prices because of how they've handled this in the past, which is typically they make the product a heck of a lot better, let users enjoy that, and then they charge for it. And so that lag, that delay has earned them the goodwill to be able to do this.
It is interesting timing, though, because as you said, they've absolutely earned the right to do this. I completely agree with that. They're doing it at a time where arguably the competitive landscape is more competitive than ever before. You know, Hulu is beefing up their offerings. Disney, all these new streaming services are coming online. So I can imagine at least one of Reed Hastings' lieutenants saying, I'm not sure we want to do this in this environment. On the other hand, it's also easy for me to imagine someone saying, no, let's do this now before Disney streaming really gets off the ground, and some of those others as well.
Yeah, I really just want to go back to the value proposition here for Netflix. I mean, think about the breadth of things that you can consume there. And even in raising their prices here, it's still going to be cheaper, I think, than HBO Go or HBO Now or whatever the heck it's called. So the cost per hour you spend watching is still so much more advantaged in Netflix's case. And the other thing I think that's worth talking about here is I think Netflix is probably going to be the one that has to lead in pricing with all of these competitors. The reality of this business is they all spend a ton on content, and they're not really making any money right now. And so this buys those other firms a little bit of breathing room to raise their own prices as well and keep in the same ballpark. The other side of this coin that I alluded to with my first comment is that does Netflix actually need to do this? Because they are spending more than $10 billion in content. They have almost $20 billion in content obligations per year, and their debt costs are rising. The last debt that they issued in late 2018, I think it was almost at 6% interest rates for $1.9 billion. So their debt costs are rising. They've got 135 million, call it, subscribers. Getting a couple bucks more across that pays their interest costs for the year. So this allows them to continue what they hope is the flywheel of investing in great content, growing their subscriber base, and having very loyal customers.
It's been obviously a phenomenal long-term ride for Netflix shareholders. In the short term, for anyone who looked at Netflix shares right before Christmas when it was around 230 plus a share and thought, for Christmas, I'm going to buy myself a couple of shares of that. Well done, because now it's north of 350. So,
there you go.
So that's worked out well. It's interesting. I hadn't thought of that before. The point you touched on about competitors and how they may view this, because now that you mention it, I'm sure that whether it's Disney or Hulu or any other service, I'm sure they're maybe not popping the champagne, but they're probably pleased to see, Netflix, the cost of Netflix is going up. Great. This either gives us an ability to market lower prices more aggressively, or it gives us the cushion to bump up our price a little bit.
Yeah.
Is there anything on Netflix you're watching these days, or you're just immersed in conference calls?
Immersed in conference calls is the right answer, but my favorites are Making a Murderer. I can't wait till they have another season there. And I like Hip Hop Evolution, which I believe is coming out with its second season.
I'm completely unfulfilliar with that show.
Get with the program.
What? Give me the 30-second description of Hip Hop Evolution.
It walks you through the evolution of hip hop.
It's a documentary. It's not a fictional series. It's just okay. All right. Did Rob Brunette turn you on to that?
No, that's my own jam.
Rob knows more about music than just about anyone I know. So if anything cutting edge when it comes to music, I assume Rob is right on top of it. One of our colleagues. Thanks for being here. As I mentioned, so just to pull back the curtain on life here at Fool Global headquarters, I mentioned yesterday we had the snow and areas shut down in schools and that sort of thing. And so Dan Klein and I taped Market Foolery. And then a couple hours after that, the fire alarms go off. And I thought to myself, wait a minute, I don't think we have a scheduled drill. And it turns out this was a legit fire alarm for legitimate reasons. And we ended up all huddling outside for about 30 minutes or so. And that's where I saw you. So in hindsight, I'm actually grateful that we had the fire alarm go off, because otherwise I probably would not have known that you were on the premises.
The stars have aligned, Chris. This was meant to be.
I say this every time Bill Barker is on the show, that folks should go to MFAM Funds and check out the latest writings from you and your team there. This morning, I actually went to mfamfunds.com myself because I realized, I haven't done this in a while. And I thought, well, I want to see. You guys have a new website, which is absolutely fantastic.
It's slick.
It looks great, but also just the content, everything about the site is great. So kudos to you. I know you probably didn't design it, but I'm sure you had a hand in saying, well, let's make sure we include these things. So
I can take no credit other than general inspiration for those who worked very hard on it.
Well, go to mfamfunds.com and check out a phenomenal brand new website. Bryan Hinmon, thanks for being here and thanks for making time.
Always a pleasure, Chris.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Austin Morgan. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.